The reckoning day for a massive default crisis has finally arrived. Experts have been alerting about the dangers of the Federal Reserve policies for almost 10 years, but bondholders seemed unbothered and continued the purchase of risky bonds that are now in huge debt. The loosened policies, which used to provide quick yields for market managers, have turned out to be the trigger to a major debt bubble that will crush a dramatic number of businesses for good, while disrupting all the prospects for a swift economic recovery. Now, we're in the middle of a new era of U.S. businesses' bankruptcies, and according to a recent assessment, 99% of the losses experienced so far are related to bond defaults. For that reason, today, we're going to carefully examine this deteriorating economic landscape to give you a better idea of what's coming in the next unfoldings of the United States economic collapse. So stay with us. Don't forget to give this video a thumbs up, share it with friends, subscribe to our channel to keep updated with the events of this 21st century economic depression. For several years now, economists have been stressing that a default cycle was in the making, and when it emerged through the surface, it would be marked by the record low recovery rates. In fact, in 2016, Zero Hedge had not only foreseen this event, but also listed the main issues that would lead us to where we are now. Amongst those, 3 stood out. The first one concerns the disconnect between fundamentals and asset prices as a consequence of the Fed's constant manipulation of markets. Secondly, the record layering of debt upon debt, most of it secured. And finally, the years of covenant-lite deals that significantly reduced, in some cases, it eliminated creditor protections. Then, yesterday, Bloomberg published an article titled "Bond Defaults Deliver 99% Losses in New Era of U.S. Bankruptcies," in which it described that more and more bondholders are battling over recoveries as low as 1%. Seeing an economy hardly hit by the health crisis, which prompted widespread shutdowns that sparked a major spike in bankruptcy filings, many lenders are starting to realize their claims have become entirely pointless. Instead of recouping, say, 40 cents for every dollar owed, as has been the norm for years, unsecured creditors now face the unenviable prospect of walking away with just pennies, if that, the report exposed. Some of the most evident examples of this epic collapse in recoveries can be seen in the current price of a handful of retailers' bonds. Men's Warehouse, which filed in August, traded this month for less than 2 cents on the dollar. When J.C. Penney went bankrupt, an auction held for holders of default protection found the retailer's lowest price debt was worth just 0.125 cents on the dollar. For Neiman Marcus, that figure was 3 cents, Zero Hedge informed. As we can observe in this chart, median credit default swaps auctions are facing record low recoveries for bondholders. This year, in fact, the median value for companies' cheapest debt in credit derivatives auctions is merely 3.5 cents on the dollar, an all-time low which is far below the 23.4 cent median for 2005 through 2019, according to Barclays. Such derisive figures corroborate with the assertion that record low recoveries for bondholders are now the norm. Even though Bloomberg argues that, while few could have foreseen the health crisis's toll on the economy, the depth of investors' pain from corporate distress was all too predictable. Clearly, it wasn't predictable enough for all the bondholders and yield leech managers who are now struggling to get any recoveries, in some cases just years after purchasing the debt at par. As Bloomberg outlined in the article, desperate to generate higher returns during a decade of rock-bottom interest rates, money managers bargained away legal protections, accepted ever-widening loopholes, and turned a blind eye to questionable earnings projections. Corporations, for their part, took full advantage and gorged on astronomical amounts of debt that many now cannot repay or refinance. Without surprise, the Fed's extraordinary monetary policies are being pointed to as one of the main reasons for this substantial surge in corporate debt. Even Bloomberg sees it, acknowledging in the report that this situation is a stark reminder of the long-lasting repercussions of the Federal Reserve's unprecedented easy money policies. Ultra-low rates helped risky companies sell bonds with fewer safeguards, which creditors seeking higher returns were happy to accept. Now, amid a new bout of economic pain, the effects of those policies are coming to bear. However, the massive burst of defaults that would likely result from the lack of protection of covenant-lite deals, ultimately obstructing a recovery for lenders' investments, has been a topic of discussion for many years. In 2018, Senior Covenant Officer at Moody's, Derek Gluckman, highlighted that while the rate of deterioration in covenant quality has slowed, protections remain distressingly weak on average. Investors should remain wary given the risks presented by most loan documents and the likelihood that any steadying of covenant protections is temporary. Gluckman also noted that collateral continues to be a critical concern for investors and alerted that the loosening of covenant protections would increase the risk that the collateral securing loans wouldn't be available to support recoveries in a bankruptcy scenario. On the same note, a study by LCD examined the debt cushion of outstanding loans, which is configured by the amount of debt in a borrower's capital structure that is subordinated to the senior loan, and discovered that today's covenant-lite deals have almost no debt cushion beneath them. And in some cases, there's none. The lack of a debt cushion significantly reduces what an investor can recover on a loan if that credit defaults. That is to say, considering the colossal spike in defaults that we're currently witnessing and the lack of protection of these bonds, lenders are now having to cope with their investments being completely wiped out. Bloomberg wrote, the loose lending terms that investors have agreed to mean that by the time corporations file for bankruptcy now, they've often exhausted their options for fixing their debt loads out of court. The report continued by revealing that they've swapped their old notes in exchange for new ones, often borrowing against even more of their assets throughout the process. Some have taken brand names, trademarks, and even whole businesses out of the reach of existing creditors and borrowed against those too. While creditors always do worse in economic downturns than in better times, in previous downturns, lenders had more power to press companies into bankruptcy sooner, stemming some of their losses. Undoubtedly, the health crisis has acted as a catalyst to trigger this unprecedented wave of defaults, and lockdowns have pushed the situation to another level of complexity, since it severely disrupted industries such as retail and energy, making it harder to determine the future value of assets like stores and oil wells, driving the already dismal recoveries further down. But despite the effects of the sanitary outbreak, the primary issue for most companies is one that's been building up for years, with the explicit endorsement of the Fed, the overwhelming levels of debt they've accumulated after borrowing with abandon over the past decade, then topping up with more to get them through the economic collapse prompted by the health crisis. The Bloomberg report continues, for bondholders, the kind of liabilities that companies have added makes the problem worse. Loans have been a particularly cheap form of debt for many companies over the last decade. Those borrowings are usually secured by assets, leaving many corporations with more secured debt than they've had historically. That means that unsecured bondholders end up with less when borrowers go broke, signaled Bloomberg. In this sense, it outlines that the record amount of secured debt is actually translated into zero recovery cushion for unsecured debt lower in the cap structure. As Dan Swern, founder of Arena Investors, a $1.7 billion investment firm with a focus on credit, has recently stated, he said, "We'll see companies gradually hitting the wall. It's just a question of when and how fast. There's just gonna be way more downside." In essence, the main determinant to recoveries is the worth of a company post-bankruptcy. And it's when it comes to this point that investors realize they've become exposed as well. On one hand, while unsecured creditors probably predicted catastrophic recoveries in a default cycle, secured lenders were expecting that their collateral coverage would guarantee a par recovery in a worst-case scenario. But valuations have fallen so deep and asset values are so depressed, even secured debt is dealing with drastic impairments. At this stage, loan investors could find themselves losing 40 to 45 cents on the dollar, compared with historical averages of 30 to 35 cents, according to Barclays estimates. But economists are suggesting that these figures might even be too optimistic, since the health crisis is still lingering. Barclays' assessment warns that the predominance of covenant-lite deals implicates that creditors are now going to experience unprecedented pain. As it states, one factor that's hurting money managers is the erosion of investor protections known as covenants, as more and more high-yield and leveraged loan deals are covenant-lite, meaning they feature minimal such safeguards. When corporations had more restrictive covenants, borrowers had less room to fix their debt outside of court, sending them into bankruptcy closer to the first sign of trouble. Now, companies have more leeway to seek extra financing when they're in trouble, and to give lenders providing additional funds the right to jump to the front of the line if the company does go bankrupt. This is also something previously alerted by economists who from the beginning argued that covenant-lite secured loans were in fact an unsecured bond. In July 2019, Third Point's Dan Loeb has predicted this outcome while affirming, quote, "Covenant-lite loans will lower the overall default rate but result in higher loan loss severities in a stressed credit environment," unquote. Those who could see it coming are now reaping profits. That's one of the reasons why Loeb keeps generating alpha, while most of his peers, even as the hedge fund industry quietly dives into oblivion. In any case, now others are also opening their eyes. The senior managing director at FTI Consulting, Sanjeev Kamlani, has recently noted how covenant-lite paper usually means by the time you get back to the table with the borrower, the house is on fire. All of that extra time you had before, that's just gone away. Other examples that portray the collapse in secured recoveries were also described in Bloomberg's report, which reveals that investors who bought a J. Crew Group Inc. term loan at par in 2014 might have assumed they were making a reasonably safe bet, considering it was a secured debt. But when the company started to face hardships a few years later, it relocated its intellectual property, including its brand name, to a new entity, a measure enabled by fairly loose covenants. Then, the company swapped some of its existing bonds for new notes, secured by the intellectual property, and also the preferred stock and equity in its parent company during a process of broad restructuring. As a result, loan investors ended up suffering, and as pointed out by Bloomberg loan valuation estimates, after the company filed for bankruptcy back in May, the 2014 obligation was worth less than 50 cents on the dollar. With all that said, it seems that creditor pain is only starting, and now they're just coming to the realization of what 10 years of covenant-lite deals will look like in terms of recoveries. And since almost 20% of the debt in the U.S. high-yield bond market is now in some way secured, compared to just 6% in 2000, we're about to see another tsunami of bankruptcies that will likely resonate on the burst of the corporate debt bubble once again. And this time, there's nothing the Fed can do to stop the bleeding.